natural rent growth. We'll call it market rent growth. We're not counting on it. It's gone away.
What's going on, everyone? Vinny Celeste here. We're going live to another Cash Flow Digest episode Friday. Justin, thanks very much for joining us.
I'm so excited to be here, Ben. Thanks for having me, man. Asset management takeover. Let's go.
Yeah, I love it. Anytime Matt goes away, I get to think about what we're gonna do to turn things over here. And thanks for stepping in. We got a really good show planned. So
happy to be here. Happy to do it. So you can even call me when Matt's still here every now and then. It'll be okay. I'll come in.
That would break the internet. 3 people on the screen here. But, so guys, we have a really great show planned here. It is a live show, so let's highlight what we're here to talk about. So we've got some really interesting news and reports from a company called Yardi. They have access to data really across the nation of multifamily data, really tracking some interesting stuff there. So Justin and I are going to dive into all that and what trends we're seeing in rent growth across different markets. Scouring the internet this week, we saw an interesting headline. It was pointing to year-over-year rent growth, right? It's so important to understand your market and what rent growth is going to do, because when you're projecting out your pro forma and really exit rates and that sort of stuff, it's important to know what your cash flow is going to be out. So there's been a time where people were able to project out rent growth 5% year over year. And gosh, this data will show you that's a risky method to underwrite now, 5% year over year rent growth, especially in your first year of ownership and that sort of thing, right? So always interesting data coming out of this. But what it highlighted was a 0.4% increase year over year rent growth across the nation. I'm going to show you in a minute here a more detailed view as we look into the different markets and metros, but you're going to see how 0.4% doesn't tell the full story, that it's a story that needs to be understood about your market and in your region. So we're going to get into it. But Justin, first, what do you think about all this, right? This chart, the shape of it.
Natural rent growth, we'll call it market rent growth. We're not counting on it. It's gone away. You can see there that chart. And I guess I'd love if they went back one more year, but October 20 of 2020, through 2020, through 2021, into 2020, early 20, that was, as we all know, prime COVID time. And what was happening in COVID time was we had an eviction moratorium, but rents just piled up on top of each other. We could not raise rents fast enough during COVID. We were putting out quality product. Rents were really ballooning to the point that we were talking about, well, this market's grew 15% this year, and this market grew 20% this year. And we heard kind of crazy numbers like that. People got excited and they started forecasting and projecting and everything. Thankfully, we're not the kind of company that thinks that that's the thing that's going to keep happening, right? Market rent growth. We're talking about average rents here. You can see what happened in 2020. Basically leveled. The eviction moratorium had ended. We're leveling off. People are getting back out into the world. We're returning to sort of a more normal economic cycle. And so you see, some fluctuation there. Honestly, that might be kind of like a seasonality kind of flux, but basically flat from the beginning of 22. Now we're at the end of 23, right? And that really jives with what we've seen on our properties. Now, a few kind of caveats, because this is a national chart. So this is looking at class A, B, and C. This is looking at small properties and large properties. This is looking at properties in Maine and in Washington and in Florida and in the Sun Belt and in Texas, everywhere. National all combined, okay? What we do is we focus on really 2 markets, right? We're in Kentucky, we're in North Carolina for the most part. We have some smaller properties in other places. But looking at a chart like this, what I gain from this is, hey, you can't count on market rent appreciation. Now, that being said, what's the number here? We're at like $1,700 is kind of where we're at right now, is what they're talking about, national average rents. Vinny, our portfolio, do you know what our average rent is in our portfolio?
Not 1,700.
It's about 900, right? High 800s to 900.
Oh, there, nice.
Okay, so a little more than half of that, right? So when you talk about national average, you could say, oh, national average rent is $1,700. Well, that's great, but that doesn't apply to my C-class assets in Kentucky and in North Carolina, right? So we have to be able to separate ourselves from the data while also recognizing a trend. And the trend that I see here is rents ballooned through COVID and then leveled off. And generally, I would say that is a true statement for us in our C-class assets where we are. But what we do, Vinny, as you know, is value add. And so what this doesn't, this is just kind of factoring all rents at all levels. But when we buy properties, we're not just buying and holding and leaving it alone, right? We go in with a heavy CapEx budget. We're going to go in and we're going to fix all the safety items, and we're going to revitalize the pool, and we're going to rip those old splintery playgrounds out and put in new ones. And We're going to pay for police patrols to clean up the crime. And we're going to renovate the units, of course, right? And I'm going to put new roofs on. I'm going to light the place up. And maybe I'll get a muralist out there, right? All these things go to our value add strategy. And so when we're doing a value add strategy, there's a clear, current as is case of like, okay, the rents at this property are this number. But if I go through the work, I put the work in, I can achieve a higher level. And so what I'm looking at is not one number, one metric, for that natural rent growth. I'm looking to take something that lives here that's rough and bring it up to something that's here that's better. Now, during COVID times, when we got to here, we renovated. Let's say we renovated from this gap, it was still growing so fast, right? So we were like trying to keep up. We couldn't raise rents fast enough. But as long as you have that gap from where you are, putting the work in, doing the renovations, you're still going to capture that upside. So this is not factoring that in. This is saying, but by what we're doing, we're able to bridge the gap from like a low C or D type property up to a C plus type property. And there's a different market, different rental rates. So we add value through the targeted renovations that we do across the property.
Yeah. And what I usually tell our investors and students is that taking that business approach, it really allows you to take ownership of the business plan and not rely on market factors like we're looking
correct
here as much. Especially when you consider the breadth of your wealth generation in a value add is going to come from equity growth and appreciation of the asset. So enforcing that appreciation and doing all that hard work, yeah, you're able to enjoy cash flow by increasing, income, but you're also adding a lot of value that will come back to you tenfold in the back end.
Right. So I might go in and put $7,000, $8,000, $9,000, $10,000 into a unit, but I'm taking that rent from $700 to $900, right? And I'm just throwing out number examples here, but we look at that ROI and we say, is that worth it? Right. Where this really comes into play, Vinny, is as we're looking at new deals, right? As we're underwriting, I work very closely with our underwriting team. We're projecting out what does rent growth look like? Because in our models, okay, we're going to take it from this number, we're going to renovate, it's going to go to that number, but where's it going from there? And so right now we're not modeling rent growth based on this data. We're not modeling future rent growth. We can't, we're not seeing it. We don't know if it's going to go down. We don't know what's going to happen. We're just saying, look, market rent is going to be zero growth. We're going to come in, we're going to do that natural rent appreciation through the renovation. And then maybe 5 years down the road, the market will start moving up again. And that's how we're planning to make money on anything, which is also making our underwriting harder. And is also why we haven't bought a property in a while, because if I could go in and project 6% rent growth per year, then those properties would look a lot more attractive to me. But based on the data here, I can't. I'd be not a good steward of our investors' money. Would not be a good plan to say we're going to see the kind of rent growth we saw during COVID or even before COVID. Everyone
should download this report. It's really great. There's a lot of really great commentary. But what I found interesting was this chart, that graph that we were just looking at in this 0.4% statistic that I was pointing out, as Justin mentioned, that's the national average, right? And there's a much larger story. We're just looking at 30 metros here, and these are big cities. These are 30 big cities. There are many, many more cities behind all this, right? So we can get even more granular. What do you see when you look at this, Justin, between New York City being at the top and other cities like Austin that has been in the news over and over again as a great city to invest for years and years?
Well, that's exactly it. That's exactly what I was going to say to you, Vinny, is, how many years did everyone say, you got to be in Austin? If you're not in Austin, you're missing out. Rent growth is extraordinary in Austin. Everyone wants to be in Austin. Created a bubble, right? And so, for us, we invest in unfortunately, some of these areas that are on the lower side over here. So our portfolio in Winston-Salem is about equidistant, about an hour and a half from both Raleigh and Charlotte. And so thankfully, Winston-Salem is not a market that's going to make this list. It's much smaller, but I can look at the data sort of around it, and I can look at Raleigh and I can look at Charlotte, and I can see what's happening there and how is that playing in with the tertiary market kind of situated in between the two, right? And so that's something that we look at. So if your market is not on here, but if you are, you got New York and New Jersey up there, okay, well, Connecticut is probably very similar, right? Because New York, New Jersey, Connecticut kind of always go northeastern Pennsylvania or something, or southern New York. I don't know, that whole area, that whole kind of metro, you can kind of loop it in. So you can look at the context clues around there and get that same kind of data. So for me, I look at the Raleigh data, I look at the Charlotte data, and that kind of matches up for what we're looking for. This kind of all goes back to the point of you have to have the long-term view. We, as a company, our strategy is not to flip in and flip out because of this, exactly because of this. Because if you were in Austin 2 years ago and said, hey, we're gonna flip into Austin, we're gonna buy this thing, 200 units, we're gonna sell it 2 years later because everyone loves Austin. Well, yeah, everyone loved Austin 2 years ago, but now you're seeing declining rent growth, right? And so now there's a lot more risk on that because everybody hopped in. So we like our tertiary markets, we're stable, but the long-term view is what really helps us, because this will fluctuate back and forth. And in a few years, New York City might be on the bottom of that list. These markets flip and flop. But in the long term, if you're planning not for a 2-year plan, but a 7, 8, 9, 10-year plan, that gives you the flexibility to exit when the market timing is right and not be forced to exit in a time when Austin has just fallen off a cliff and declined.
That's great points. And what I hope folks understand is, and Justin, what I'm hoping we can get into here too, could you explain to folks what loss to lease is? Because we're not saying to be careful of these markets going up and down. That's going to happen, those fluctuations. But our business plan is predicated on a large loss to lease, and the value add that we're providing is meant to close that loss to lease. And so there are times where you're able to increase income even if market rents are going down, by focusing on acquiring assets where there is a business plan where you can still increase income without relying on that market rent increasing like we do in our underwriting.
Yeah. So loss to lease, I'll explain it like this. If I raise market rents on a property, legally, I can't just go raise everybody's rents. I have a lease, right? So let's say I have a 12-unit property, Vinny. In theory, on average, let's say one lease expires every month, just for our example's sake. So I've got one lease that expires in January, February, and on. If I, in January, decide I'm raising rents $100 because that's what the new market rent is, or I'm seeing rent growth, I'm in New Jersey, wherever market rent is higher, all the other comps are showing that I can do this, I'm going to raise my rent. So I'm up $100. So if I raise rents before my renewal for January, I can lease my January unit at that new higher rate. But I can't touch February, March, April, May, June, July. I can't touch those other 11 because I have leases, I have contracts with them. And so my loss to lease now is I've raised that rent $100 for all the units. I've raised what the market rent is, but I won't actually be able to charge that market rent until that lease expires. So the gap between what the market is and what I'm actually charging is loss to lease. We actually always want a little bit of loss to lease because that means we're continually pushing rents. So if you look at any of our T12 statements, our financial statements for our properties, you'll see a big loss to lease, which means market rents are higher than what we're getting. And then if we're doing our job, the gap gets smaller and smaller, not because market rents are coming down, but because the actual rents, the charged rents on the property where we're charging the tenants are going up, up, up. You'll see, okay, maybe we're getting closer. And then by June, we're getting fairly close. Well, now it's time to raise rents again. So I want to see another big jump in loss to lease. That means I've raised my rents again. And then I'm going to spend the next few months, as I'm signing new leases, bringing everyone back up to our new market rent. And so we're constantly evaluating what the market is. These kind of tables are great and good to inform us, but they're not how we're going to make our rent decisions and what we're charging on rent, because what I'm charging for rent in my property is dictated by what everyone else in my neighborhood is charging for rent for a similar property, similar size unit, similar age, vintage, amenity set, all that kind of stuff. So just the same way as like you're trying to buy a house, you're not looking at national data. You're looking at what's happening in that neighborhood. My house is worth what my neighbor's house sold for, right? If we've got the same kind of square footage and floor plan and age and all that. Same thing with rent.
Right.
My 2-bedroom unit, built in 1975, renovated with white cabinets and granite countertops and black appliances and XYZ square footage, right? That's worth what the other property across the street, if we have a similar amenity set and all that. So our managers are constantly calling. They're always on the phone every single week. They call all the other managers in the area, and everybody does it. So it's like it's a well-known industry thing. There's no shame in it. It's what are you charging? What are you charging? What are you charging? What's your rent? What's your occupancy? And so everyone is kind of in tune with what's happening in the marketplace. So then you'll see if one property starts pushing up, everyone else will kind of wait and watch. Okay, are they getting it? Oh, they're starting to lease at $50 more. Cool. Let me do that. Or, oh, that property just rolled out a water charge fee. We'll do the same thing. And everyone just kind of follows each other to make that market. But it's hyper local, very, very tight, and really has nothing to do with this big picture data, though this is showing us the larger trend that these little micro interactions are happening within. Yeah, no. And where I was actually trying to take this to is that if you look at the differences between class A, B, and C assets, right? I want folks to understand that there's loss to lease really identifies the difference between market rent and what the asset is currently charging for rent. And in that gap is the opportunity. By improving the asset and justifying increases in rent by providing a better product, you're able to close that loss to lease and begin to increase income. Now, Justin, to this effect, what would you expect to see a class A asset have a much smaller loss to lease, since they're pushing the market? They're the premium of the market, and these are new assets that are just brandly, newly renovated. I would imagine that those loss to leases are much small, and that's might be a really good point to point out why B and C class assets have this opportunity to invest in even
if there's fluctuations in market rent growth on the macro level?
Yes. I mean, the newer the asset is, the more standardization there is, right? Our opportunity is in the mess, right? And that's where we found our niche. So if I've got a property built in the 70s or 80s, it's had 30, 40, 50 years of mess. So one owner came in and renovated half the units. One owner came in and decided they wanted new cabinets. One owner came in and decided we're redoing all the cast iron plumbing, whatever, right? Their properties are an accumulation of every previous owner's sort of vision and business plan and all that. So the newer it is, if it's only had one owner or two owners, but it was built 5 years ago, chances are there's not much variation, right? So it's kind of standard. We see that opportunity in, okay, let's figure out where the nicer units are, and let's figure out where the nicer units are not, and are there enough units that we can bring up to that next level and elevate to that next standard? And that's where we take advantage of that loss to lease and try to drive value.
Right. Well, thank you, Justin. So I appreciate you spending some time with me on your Friday and everything like that. And everyone listening, whether you're on Spotify or here with us live asking questions, we appreciate you too. Talk a little bit about rent growth across the nation and what that means at the macro level, but also the micro level, and how you might affect your business planning strategies. So folks, we spent a lot of time talking about skills and how you could fit in these teams. If you want to learn more about where you might fit into a real estate team, head to DeRosaGroup.com/superpowers to take the superpower assessment test and also find out where you might fit in. But if you're looking to take a way deeper dive and really a consultation, head to DeRosaGroup.com/accelerator. We do have a program out there, and we're really happy to dive into your business and help implement these systems and processes for you. So thank you everyone for listening, and I hope you have a great week. Take care.
Thanks for having me, Vinny.
Yep. See you.
Hey guys, Matt Fairclough here. Thank you for listening again to the Cash Flow Digest. I really appreciate you guys doing that. If you guys want to hear more about what DeRosa Group has to offer, go to DeRosa Group, DeRosa Group.com, DeRosaGroup.com online. You can hear about all the great things that we offer from an educational standpoint and passive investment standpoint on our website. See you there. And if you guys want to join our online community, DeRosa Insiders on Facebook, where you can watch this program get recorded every Friday at noon Eastern, and you can come on as even a guest or ask questions on the show. We hope to see you guys on our online community, DeRosa Insiders. See you there.